Well, stocks rose to fresh records on Wall Street last week, while treasuries trod water and the dollar retreated as President Trump returned to the Oval Office for a second time. But this week has started on a risk-averse note amid headlines around the Chinese AI DeepSeek and the potential threat that it may pose to the chip sector more broadly. And a busy calendar now lies ahead this week, including 4 G10 policy decisions, as well as earnings from 4 of the Magnificent Seven, and a busy data docket as well. Plenty to discuss on the trade-off this week. So without further ado, let's crack on with the show. So it was a relatively calm week for markets last week, surprisingly so. A little bit of buy the rumour, sell the fact going on as Trump's bark on the campaign trail appeared to be somewhat worse than his bite now that he has come into office. But markets have thrown a bit of a tantrum as the new trading week gets underway, and it's going to be a very, very interesting week ahead. Joining me as always to try and make sense of everything that's going on is my very good friend Ryan Littlestone from Forex Flow Live and Forex Analytics. Ryan, good afternoon to you. I hope you had a relaxing weekend because I think we're going to need every bit of energy that we have given the way this week is shaping up.
Yeah, I can't wait for our new Labour government to go to a 4-day week. Then perhaps we can skip Mondays because they seem to be getting worse and worse. We're only 27 days into the new year.
Oh, you love it really, don't you?
Yes.
Right, well, without further ado, let's crack on with Topical Thunder because there's plenty for us to get our teeth into. Right, well, we could have really started anywhere this week, but I'm going to start with the Fed. It is probably as good a place as any to kick things off because, of course, this week, this Wednesday, does bring the first FOMC decision of 2025. The committee set to hold the target range for the Fed funds rate steady at 4.25% to 4.5%, and that is something that markets fully price in. Incidentally, the first rate cut is priced in June, and actually, as a result of the market turmoil that we've seen to start the week, the market is now pricing in 50 bips worth of cuts this year. So in line with the dots, all it took was a 5% sell-off in the NASDAQ. In any case, I think the big question around the January FOMC meeting is whether the skip that we're going to see this month turns into a more prolonged pause in the easing cycle. Now, firstly, why are the Fed likely to skip a cut at the January meeting? Well, I think there's a number of reasons. You've got the opportunity to take stock of the 100 basis points worth of cuts that they delivered last year. The committee will also want to assess the early policies implemented by the Trump administration, particularly those in the realm of trade. And also there's frankly, the matter that the economy is just not crying out for a cut at the moment. The path back towards 2% in terms of inflation is still a relatively bumpy one. Headline non-farm payrolls growth is proceeding at a very, very healthy clip indeed. And unemployment, of course, fell to 4.1% in December. So there's nothing really there that says the Fed need to cut again and that they need to cut quickly. Naturally, I think guidance, or explicit guidance at least, on the next rate move is not likely to be given at this meeting, although the next move in the Fed funds rate will still be lower. They will instead stick to I don't know why you look so surprised at that. They will, of course, stick to a data-dependent approach. But I think what's important to recognize is that more data of that ilk that I've just discussed is not going to see them in a hurry to get on with delivering rate cuts, no matter what Trump decides to rant away about on a stage in Davos. I think in terms of the market, there are a couple of implications here. The first is that with the Fed likely to maintain a relatively hawkish tone, particularly compared to that of G10 peers, it is likely to see that divergence between the Fed and G10 counterparts widen, which should help the dollar to continue gaining ground, although we did see some wind come out of the dollar sales last week. The other thing I would mention is that actually this year there is no Fed put. We have not got that little comfort blanket that helped to insulate financial markets last year because upside inflation risks are more significant. But nonetheless, I do think strong economic growth and strong earnings growth should be enough to see the market rally. And for what it's worth, this dip that we see, and we're recording this on Monday afternoon, is one that I would be buying into. Now, Ryan, I'm obviously keen to get your thoughts on that, but more importantly, you looked very surprised indeed when I said that the next move is going to be down.
Well, you like to paint yourself into a corner sometimes, mate. It's not that I disagree with you. I think that the next move is down. Fed still wants to get rates down. However, if the data goes against them, then it may not be such a done deal that the next move is another cut. And we've already had the market over the last week or two heading that way, getting a bit more hawkish over the Fed. We've had one of the banks saying that they think there's a risk that the next move is up. So, the market's swinging that way. The Fed, they're likely to go to skip this meeting, as you like to say. I think it might develop into a bit of a pause, but then they've got to do some work in making sure the market doesn't get too hawkish over it. I think that's why we got Waller out in the early part of January, just coming out with some dovish tones, keeping the market on its toes that, yes, we're not entering another hike cycle. But I think there's a lot of work to do because they can't ignore what's going on in the economy. They can't ignore what's going on with inflation. The market got a little bit excited when we saw 1 pip drop in the core, but that's remained above 3% for nearly 4 years now. So, there's no progress there. And that's what they keep telling us. They want to see progress. Right now, they're not getting it.
No, absolutely. I think you're right. And I think actually the best way to look at the January FOMC is really as a placeholder. December was delivering that last 25 bip cut that they promised in 2024 and giving a bit of a projection in the dots for 2025. March is when we're going to have much more data in terms of Q1. We're going to have much more clarity in terms of the first 100 days of the Trump presidency as well. The Fed are just kind of stuck between those two events at the moment. And I think as a result of that, Powell and co are not really going to rock the boat this week. And certainly Powell is going to play with a very straight bat any questions in the political realm. Because, of course, we did have the orange man going on last week about how he thinks he knows better about setting monetary policy than probably one of the most pragmatic Fed chairs ever. So I'll let you make your own minds up on that one. But I know you want to dig into the first 7 days of Mr. Trump yourself, Ryan.
Yeah, exactly. And as you rightly say, he told the Fed what they need to do, and he did that previously as well. But part of me hopes that I don't have to do this every week, or we don't have to do this update every week on what Trump's done. But I think this first week has shown exactly what we've been saying since his election win, that there's never going to be a dull moment. So far, he's enacted emergency measures, done a ton of hiring, a ton of firing in government offices, popped into Davos, as you say, to tell everyone how great he is and what America's going to do and what he's going to do. And then he got into a fight with Colombia as well over the weekend. So probably while he was playing golf as well. So I think we're also bound to hear from him over this DeepSeek stuff, especially coming so soon after he's announcing his new AI program, Stargate. And it just hit me in the back of my mind, this DeepSeek stuff dropping not too long after that news came about. So maybe some shenanigans there. But explosive headlines aside, I think it's important to analyse his first week and what it actually means going forward. His tariff threats to Canada and Mexico are not on trade. They were on immigration, drugs, crime, that sort of thing. So the trade side of things is still yet to come. And he's been taking really a softer opening stance than expected with China as well. All that has helped ease the tariff trade that we were seeing pre-inauguration. Now, that doesn't mean stronger rhetoric isn't coming, but it feels as if he's maybe picking and choosing his battles more carefully this time around, and maybe giving some countries or blocs some time to think about things before he does start dropping out those tariffs. And that's another reason why I think the Fed, as you say, might be forced into a bit of a pause. He said last week that he wasn't going to get straight into the trade stuff. He's sending off his teams to look at all these trade deals, and could be March, April before they come back with any sort of reports that he may act on. But that's not going to stop him throwing the headlines around and truth bombs in the meantime. So this week, it should be, touch wood, about the central bank meetings. And but if these first 7 days have proved anything, is that you cannot switch off for a moment during trading.
Yes, it should be about that. Whether it is or not, I think remains to be seen. And actually, your last point there is perhaps the most important. And I think it's still something that market participants more broadly are adapting to, or more precisely, readapting to. This idea that actually we can't discount a concrete future policy path because there isn't one. I don't think even the bloke in charge has a concrete idea of what's going to happen next. And also, I think that's contributing, and well, clearly we're not seeing that this morning, but contributing last week at least to a little bit of kind of stalemate in financial markets, where particularly across the Treasury curve, I don't think anyone really wanted to do anything, because you don't want to be the man or the woman who puts a trade on, goes off to grab a pint or a sandwich, and then while you're stood there eating that sandwich, you see a post on Truth Social and the market is suddenly a few hundred ticks in an adverse direction. And I think that has limited conviction to a degree. I think the other thing I would say in terms of tariffs, one of the most interesting things is actually for me what happened with Colombia over the weekend. Of course, again, in the realm of immigration, Colombia turning away these US planes. I think while the planes were still in the air on their way back to the States, Trump slapped 25% tariffs on imports from the nation. So it just reaffirms the idea that actually, yes, tariffs are a trade metric, but they are also what Trump is going to use to, well, one, bring people to the negotiating table, and two, to effectively get his own way with things, because until people agree with what he wants from the US side, those tariffs are just going to get higher and higher and higher until whoever it is on the other side it eventually caves to his demands. So I think the market is slowly wising up to that as well.
Yeah, absolutely. And that Colombia situation was the perfect case. I mean, Colombia said they were going to retaliate in kind and slap 25%, 50% tariffs on as well. And then a few hours later, all of a sudden everything's come to a nice conclusion and everyone's happy and they're going to take these planes after all. So I guess there were some hurried phone calls and maybe Colombia thinking, do we want to get into this sort of argument over a couple of hundred immigrants to the US, our own citizens? And that's probably why they folded.
Yes, indeed. Right. Well, from one orange person to another, time to talk about the ECB and, of course, Christine Lagarde, who will host another likely tedious press conference on Thursday lunchtime. Of course, the ECB set to deliver, excuse me, a 25 basis point cut to the deposit rate this week. That would, of course, be this cycle's fifth rate cut and would bring the deposit rate down to 2.75%. Looking at Eurozone money markets, we see that the curve is fully pricing the cut this week and also fully pricing another cut at the March meeting. And I think probably your and most participants' base case at the moment is that the ECB will just keep delivering these 25 basis point cuts at every meeting until rates get back to what they would reasonably describe as a more neutral level. Once again, we're in a situation where the ECB are the only game in town to help the Eurozone against a whole long list of risks that the bloc continues to face. Of course, you've got the ongoing geopolitical situation in the Middle East and also in Ukraine, Trump and the potential for tariffs to be slapped on the bloc, the continued lack of anything resembling an economic recovery in China, and also the ongoing political shambles, let's be honest, that is taking place in both Germany and in France. But I do wonder whether the tide is starting to turn. We had some better than expected data out of the Eurozone on Friday. The flash PMI figures for January, the composite index at a 5-month high, back above the 50 mark. The manufacturing index, yes, it was still in contractionary territory, but it was an 8-month high. And I know things are coming off a very, very low base here, and overall economic momentum remains very, very weak indeed. But I do think that there are some increasing signs that we may be at or getting past that moment of peak pessimism when it comes to the common currency at the moment. And I know I made this call back at the end of last year, whether it was November or December, whether we'd see 110 or parity first, and I came down on the side of 110. And I reaffirmed that call given the recent shenanigans that we've seen going on in the Eurozone.
I think I was the same side of you for that call, wasn't I? I think in 110.
We'll have to go back and check the tapes, I think.
Yeah, check the tapes for that one. I think you can measure the ECB and the Eurozone with two main cases. You may think we're getting over peak pessimism. I don't think we are. Not at the moment. I think those January flash readings from the PMIs just show a bit of post-holiday season bounce because there was nothing really strong in them. Of course, if it develops into a trend, that's a different story. But I see no reason why things should start improving on the basis of what's been happening for the last year, 18 months. I don't know if, though, on the other side, maybe the ECB are going to start to pause. And I think that's the risk for this week, whether they start to indicate that. We've had Hawke Holtzman, who's been on side with the cuts recently, flipping now, and he's suggesting that he's going to be in the pause camp because he doesn't want to start cutting or get cuts down too quickly or get them or speed them up so they're too fast, and then that brings another problem. They've also seen a little bit of an inflation bounce, and that's coming all the while they've been declaring victory laps, or some of the ECB members declaring victory laps over inflation getting to target. So inflation is there or thereabouts near target. So I think this is going to be a bit of a tough meeting on as to whether they continue to cut because there's still economic weakness, or whether they think maybe we need to just ease up or indicate we're going to ease up on the gas pedal over the months ahead, just to let those prior cuts feed through and see what happens after that. So I don't think it's a done deal. I think they cut this meeting. I don't think it's a done deal that they continue every meeting. But again, going back to the economic side, and this is something I said coming into this year, with economies so weak as they are, it's going to force countries and firms to cut prices to get that business back in. We saw it potentially in the French PMI, where output costs were down for the first time in years. And if firms are starting to cut charge costs, should I say, to get that business in, that's going to bring another round of disinflation, and that's potentially going to force the ECB to have to cut faster. So if it's a fire sale coming in Europe, that's going to tip the ECB into faster cuts. But otherwise, I don't know. I think after this cut, it may not be such a clear route.
A little bit more hawkish than I was expecting there. I think they'll probably look through the uptick that we've seen in inflation. A lot of that is energy and base effect related. I'd also say that Robert Holtzman probably has about as much impact on what the ECB do as you or I on this programme. He is very much an outlier among policymakers. And I don't know what it is. It seems to be a trend at the moment where these outliers among their peers, whether it be at the ECB or whether it be Goolsby at the Fed, the more extreme one's policy views are, the more often it is they seem to appear in front of a microphone. But one day maybe they'll stop being given airtime. In any case, let's move on, because I know you want to look at some of the key levels surrounding this plethora of policy decisions coming up this week.
Yeah, absolutely. So we've got several central banks reporting. We've got the Riksbank, we've got the Fed, we've got the ECB, among others. So, yeah, there's lots to look at. Bank of Canada as well, right in the middle. So there's plenty of asset moves we can look at. And I'm going to look at currencies, start with the Riksbank and Euro Stocky. And we've been working in this big wedge since 2023, and I think it's a low chance, but we might get a look at the lower end of that range over the Riksbank if they cut and then decide to go on pause, because I think they are perhaps another one that's going to maybe do another cut, then see what's going to happen with the rest of rates. Now, that lower end is around the 11.34-35 area, and before that, we've got a key level around 11.42-43. Now, we've had 4 attempts down there, and none of them could get through that level. Or, when it has broken, hold a breakdown there. So if that holds a test over the Riksbank and ECB, I think we're likely to see a bounce from there, and then maybe we start to push higher. Although I would say we are in a short-term downtrend. So it's one of these ones where you may see the lower end of the range, but don't think it's going to rally too hard if it does bounce. And then we move over to the Bank of Canada, and obviously the Fed dollar CAD is the next pair. That's been locked into a very, very tight range coming into this year. That range is between 143 and sort of 144.70, 145. There's been a couple of extensions either side of that, and I think, though, that this is one of the most simple to trade. We're either going to hold the range or we're going to break it, and we may break either side of that depending on what the Bank of Canada or the Fed do. Now, topside break, I think that would look to target, there's a massive double top up around the 147 area. And while the downside break, I think if that happens, we're probably looking towards that 140 level. That's going to come in across here as a big, big level, old level, and psychological level as well. Now, I would be cautious about making any decisions, trading decisions, until we know the outcomes of both meetings. That way, we'll see if the range has held or if it's broken, and then you can potentially trade the confirmation of that break. What you don't want to do is trade on the back of the BOC where the range is broken, and then the Fed come in and send it the other way. Lastly, and then I want your thoughts as well, Michael. Euro dollar is perhaps at a bit of a make or break moment for me. By the time we get to the ECB, the Fed message will obviously be known. A dovish Fed would be a bit of a shock. So the balance of risks points to more dollar strength, and that means euro dollar dipping. That said, any dip might reverse somewhat if the ECB then do hint that they may also be heading for a pause. So for me, if we see 103, 30, 50 as a big zone down there holds on both the Fed and ECB dip, we're likely to see another bounce. I'm not expecting this to run up to the 112 again, but I'm also not expecting to see the 102 tested. And if we are, someone has either been very hawkish or very dovish, or a certain Mr. Trump has dropped some truth bombs. Now, if there's no shocks from either bank, it's likely we continue to see this recovery, and maybe we go and have a look at the 106, potential 107 area. So what I want to ask you, Michael, is what will be your pair of choice out of this lot?
Oh, bloody hell. I mean, I think the biggest takeaway from all of that is that this week is going to be incredibly choppy and incredibly messy, because we've got so many competing forces, not just from a policy perspective, but also, as you said, you rightly said, that potential for influence from the White House as well in terms of rhetoric. I think probably the most interesting one, I would argue, is dollar CAD, simply for the reason that we do still have this threat, setting aside all the monetary policy issues. We do still have this threat of tariffs coming into place at the end of the week, and the market does not appear to have discounted that possibility at all. You would expect dollar CAD to be trading a large handful of big figures higher if we do get that 25% tariff on Canadian imports into the United States. So I think that's probably the most interesting one of the bunch. In terms of actually playing any of these moves, I think really it's a question of, certainly given the risk-averse start that we've seen to the week and the busy nature of the data docket, I think this is, firstly, a week for capital preservation. And secondly, if anyone is seeking to trade, wait until the dust has settled. Wait until Thursday afternoon when we're through all of those policy decisions. Lagarde's press conference is over. Look at where we are then in relation to the levels that you just outlined. That's the time to maybe look at taking a position. But I think you're absolutely right to say, for example, if we get a relatively hawkish 25 basis point cut from the Bank of Canada, don't go all in long the loony, because Jay Powell's going to stand up 3 hours later and could see that market reverse right back on you.
Yeah, exactly that. And that's why I'm going to play it anyway. Just wait for the dust to settle, see what happens, and take it from there, I think.
Indeed. Right. Well, I mean, there's even things we haven't managed to cover this week. I mean, we've got Magnificent Seven earnings coming up. Obviously, we hear from Tesla, Meta, Microsoft, and Apple throughout the week ahead, and a whole host of data besides. But nonetheless, we do need to move on to our plays of the day. And one of the things that we didn't get the chance to discuss is the data that we had out of the UK last week. So why don't we do that now? Now, firstly, I do still like the idea of being long volatility. And when I wrote these notes yesterday, that idea hadn't paid off. Since then, the VIX has traded to a 1 month high, and I think we're just north of the 20 handle. So I'm starting to like that even more now. But anyway, I'm going to look at the pound, because cable has run up towards a test of the 125 figure to the upside towards the back end of last week, and was continuing to loiter around that handle as the new trading week gets underway. A couple of reasons for that. Firstly, we had some better than expected PMI figures out of the UK. All three, the manufacturing services, and composite gauge rose to 3-month highs, although I would just caveat that by saying that the survey did also point to the fastest pace of job shedding in the UK economy since 2009, excluding the COVID period. So not quite as optimistic as the headline would imply. There's also been a bit of buy the rumour, sell the fact going on in terms of the dollar downside, given that Trump did not initially put in place any tariffs, as we discussed earlier. But fundamentally, for me, cable has absolutely no reason whatsoever to be trading with a 125 handle. Inflation is still very, very sticky here in the UK. Growth is anemic at best and non-existent at worst. Plus, of course, the government is still relatively asleep at the wheel as fiscal headroom continues to evaporate and the labour market loosens very, very rapidly indeed. Obviously, this is a big psychological level for the pound. We've also got the 50-day moving average lurking just above around the 125.25 mark. So I will be fading the rally here. I still see very, very little indeed to be liking about sterling denominated assets. Ryan, I assume this is a tariff play coming up.
Maybe so, but just before we move on to that, your pound trade. Oh, I think it's wise to just let the viewers know that we do have Rachel Reeves speaking this week. I think on Wednesday.
And joy! I can't. Sorry, I'll be washing my hair. What's left of it that day? You'll be polishing yours.
She's supposedly going to be listing a ton of growth boosting measures, and if the market likes the sound of it, then I think we're going to see the pound gain. And whether that's in cable or not, it might be euro sterling. But I wanted to make a quick bet with you then, just on cable. Do you fancy a 126, 124 friendly bet for this week?
If you make it 123, 127, I'll take it.
Oh, look at that. You sound like a proper broker. That's a quote wide enough to drive a bus through. Come on, where's your minerals? 126, 124.
Oh, go on then.
Go on in. Okay, right. 126 for me, 124 for you. Right, back onto my play of the day.
Can I just say on that, before we go on to your next trade, if Rachel Reeves is going around asking the UK regulators for ideas on growth, I don't think that's scraping the barrel. I think we've gone through the barrel at that point.
I think barrels was one of the growth measures, so he's probably blown that up as well. Anyway, right, moving on before Kyriakos gives us a little wave in the corner. It's been a bit hard doing these play of the days on a Sunday afternoon when you then wake up Monday and it's a completely different market. So my play of the days are going to be a bit more dynamic, which is technical speak for doing them about an hour before recording. But anyway, $MEX is my choice this week. I think I've missed a long opportunity from support on Friday in a zone that's roughly 20.0918. Quite a wide zone, but it's a decent support zone. And while that trade might still be valid if we see dips down there, what I'm really looking for is a rally to sell, particularly a Trump-driven rally. So if Trump switches tariff threats from immigration and crime to trade, that could see a rally back up to the 2080s. Now, as it's likely that threat will draw Shine Bomb, as we call her, to the table, it might be another case of Trump's bark being worse than his bite. We failed to break for that 2080s level all through the tariff threat trade. So if we can't do it again on any real headlines, that would be my signal to try a short. If we get over that 50 fib, though, around the 21s, then the trade is wrong. So that's my play of the day this week.
Good stuff. A little bit like the Canadian dollar, actually. That's one that's going to be very, very well worth watching. Also, I think we're going to see implied vols rise quite considerably in the MEX and in the CAD as we move towards the weekend. In any case, that does bring us to the end of another show. Thank you very much, as always, to Ryan Littlestone from Forex Flow Live and Forex Analytics for joining me. Thank you also to our producer, Kyriakos, for bringing things together as brilliantly as always. Hopefully, you've enjoyed the show. If you have, do please drop a like on the video. Leave a comment as well. Let us know how you're trading the markets, or if there's anything you would like us to discuss in the next episode of the show. And that will indeed be this time next week, when we will join you again to try and digest what I'm sure is going to be a very busy and volatile 4 or 5 days ahead, and another busy week the following week as well. We've got the Bank of England and the US jobs report, of course, to kick off February as well. In the meantime, have a great week ahead, and we'll see you then. Goodbye.